Today we're going to look at borrowing costs. Borrowing costs, as a rule in our financial statements, are usually expensed. So the general rule is that we expense borrowing costs in our P&L. But in terms of the standard on borrowing costs can be capitalized. So there are certain conditions where borrowing costs can be capitalized into the asset, and the main condition is that we have a qualifying asset. So the very first thing we have to look at is whether we have a qualifying asset in terms of the definition of qualifying asset in the standard. And the standard defines qualifying asset as an asset that takes a substantial amount of time to be ready for use. This definition of substantial amount of time is judgmental, and I suppose it depends in company to company whether you would determine that it is taking a substantial amount of time or not. But in essence, a substantial amount of time would be something that would would have a time value of money implication. We have money tied up in that asset, trying to get the asset ready for use, and so therefore it qualifies as a qualifying asset. It can also be an asset that's ready for sale, so we could also include these borrowing costs into inventory as well as PPE assets. All right, so if we have a qualifying asset, an asset that takes a substantial amount of time to be ready for use, then borrowing costs can potentially be capitalized into that asset. In terms of criteria, there are a number of criteria that are required for recognition of borrowing costs, and those criteria are the following, and all the criteria needs to be met. So all criteria I'm going to put over here. So the first criteria is that you must be incurring costs, expenses. So we must be incurring expenses in our asset that we are busy building and getting ready for use. The second criteria is that we need to be incurring interest. So we need to make sure that we are also incurring interest and that we have already borrowed the money and are incurring that interest. Number 3 is that activities must be started. Activities must be started. When we talk about activities being started, we mean not necessarily building activities. It can include planning activities. For example, if we are building constructing a building, activities could include the activity the activity undertaken by the architect to draw the plans, to submit them to council and get them approved. That constitutes activities, not only and necessarily building activities. So we need to be incurring expenses, we need to be incurring interest, and activities must be started. There's a little addendum in the standard that says that if you suspend activities, then you must suspend capitalizing. So if you suspend, you must suspend capitalizing. But there are some exceptions, things like acts of God. If you, for example, if there's a flood caused by a big storm, and you therefore can't continue activities, that's considered to be something that's outside of your control, and so in that case you may continue, but otherwise if you suspend activities, through your own control, by choice, then during that period, we can't be capitalizing borrowing costs. So we capitalize borrowing costs once all these criteria are met, and that's when we start capitalizing borrowing costs, and we only stop capitalizing borrowing costs then if it's suspended or once the asset is ready for use. So therefore, it is quite important that we understand dates. And so I always like to draw a timeline. As you know, on my timeline, I like to put beginning of year and end of year. It might be that activities span a year. So I might have capitalizing beginning, let's say, over here, where where criteria is met, and I would actually put all the dates on the board: when I started to incur expenses, when I started to incur interest, when activities were started. Once all three are done, then the criteria is met and I can begin, and then I put in when I must end, and let's assume end is over here. End is when I stop capitalizing and the asset is ready for use. And then I calculate my interest that I can capitalize, which in this case then is between here and here for the prior year, and then from here to here for the current year. You don't stop incurring interest. So once you've borrowed the money, let's assume you borrowed the money up here, you have to pay interest until the loan is repaid. So you're going to be carrying on paying interest all the way through until repayment of that loan. But what happens is that once you have the asset ready for use, once you stop capitalizing over there, then any interest incurred over here must go to P&L. And in fact, there will be two items going to P&L at that stage. Once you've got the asset ready for use and you've stopped capitalizing interest, the interest on the loan will go into P&L at that stage, and so will the depreciation on the asset, because now the asset is ready for use and it so therefore must be depreciated. So it's important for you to be able to calculate interest for the whole period and then to be able to split it between interest capitalized to the asset and interest depreciated. And when I talk about capitalizing the interest to the asset, and that's what will happen over here, interest capitalized, what I mean is that interest will be added to the asset, added to PPE. It's considered to be one of the costs of acquiring PPE. So if you remember from FAC3703, when we do PPE, we say all costs to acquire PPE, to get the PPE ready for use. And now borrowing costs says if it's a qualifying asset, interest is one of those costs, and you're allowed to capitalize interest and add it to PPE. Okay, let's talk about the actual measurement. How much interest can I add to PPE? So that's what I'm looking at over here. How much? There are two rules. There's a rule for specific loans, and there's a rule for general loans. You need to look at the question to see whether we have borrowed specifically for this asset. We took out a mortgage bond. We took out a specific asset-based loan for the asset that we're building. Or whether we are using general borrowings. The company has an overdraft facility or has a general facility that they use for various things in the business. If we have a specific loan, the rule is interest incurred or paid, we'll say paid, although it could be incurred as well as paid, less interest received. Any interest that you paid on the loan, less any interest you received from the loan, that's how much you can capitalize. For general loans, I can't take interest paid on the loan for general loans. I have a big loan. The loan is being used for any number of things. I can't take all the interest on that loan and say it belongs to the asset. So in this case, what I do is I take the expenses incurred and I multiply it by the percentage interest rate. Yeah, and I multiply it by the percentage interest rate. I'm going to just add a little something over here. If there are various loans, so let me give you an example. Let's assume there's a loan for 10,000 Rand. I'm just going to work in thousands, but let's assume it's millions. And another loan for 5 million Rand. And so I have general borrowings of 15 million, and those were all used for my asset or to help me build my asset. If the 10 million loan is at, let's assume it's at 10%. No, let's work with a number that will divide nicely. 12%. And let's assume that the 5% loan is at 15%. So that one's at 12 and that one's at 15. What I will do is I will weight it. So if you look at the weightings is 2/3, 1/3. Yeah, 10 over 15, 2/3, 1 over 15, 1/3. So if I weight it according to the weightings, then I get 24 divided by 3, 8. And here I get 5. Weighted average, 13. And that's what I will use. I will use a weighted average interest rate. So when I have multiple loans, I work out a weighted average interest rate. But usually what you will have is you will have one loan. And so remember the two rules, and the rules are quite different to each other. For specific loans, it's the interest that I pay on the loan, less any interest that I receive on that money. That's what I'm allowed to capitalize. For general loans, it's the expenses that I incurred on this particular qualifying asset times the interest rate. One more thing that I just want to touch on before I continue is that there are two types of general loans. There's an upfront loan. I get all the money upfront. I will pay interest on the whole amount from the beginning. The second one is a facility. I don't get all the money up front. A mortgage bond usually is a facility. As you build your house, so you get the money. If you put in foundations, you get some money. If you put up walls, you get some money. If you put on a roof, you get some money. When you have a facility, it's not all the money up front. So the calculation of interest between these two is different, isn't it? Different amounts, therefore different interest calc. And the difficulty that students have with borrowing costs is not the rules. The rules are fairly straightforward. A specific loan, once again, the amount of interest I pay on the loan, less any interest received. The only time I will have interest received is if I have an upfront loan, because I get all the money upfront. I don't need it all upfront, and so some of it I will invest and earn interest on. When I get a facility, I don't have any money upfront. There is no interest received. The only time there will be interest received is if there's an upfront loan. So that's for specific loan. For general loan, expenses incurred times the interest rate. Let's look quickly at one more thing before we look at examples. Interest calcs. Interest calcs. There are a couple of things that are important when you do an interest calculation. The first is the amount. The amount. Now, the amount that's outstanding on the interest could be an upfront, could be a facility. If it's a facility, the amount grows over time. So initially I borrow 100,000 Rand for foundations. Then I borrow another 200,000 for walls. In total, then, for the second lot, I have 300,000 outstanding. Then I borrow another 500,000 for the roof. Then I have 800,000 rand outstanding. So when I have a facility, the amount grows. Also, this amount could include capitalized interest. And I'm going to talk to you about compounding just now. But if interest is compounding, I have to add interest to the capital amount. So the amount changes if it's upfront or if it's a facility. If it's upfront, it's one amount for the period of the loan. If it's a facility, it grows. The amount changes because of interest that is capitalized, and the amount is also influenced by how expenses are incurred. And the reason for that is because if expenses are incurred at the beginning of the period, then 100% of the amount is included when I work out the loan. So if, let's say, that 200,000 rand that I paid for the walls, I pay at the beginning of the month. Then I pay interest on the whole 200,000 for the month. If expenses are incurred at the end of the period, then I carry no interest for that period. If I only pay for the walls at the end of that month, there's no interest on that 200,000 rand for that month. The interest will only be the next month. And then the third scenario is where they say evenly throughout the period. If we work on evenly throughout the period, it means that I didn't pay the 200,000 rand at the beginning. I didn't pay the 200,000 rand at the end. I paid the 200,000 rand throughout the period. So when that's the case, then I have a 50% inclusion. And I'll show you calcs that work with that. All right, so the first thing I need to determine when working out an interest calc is the amount that I'm working out interest on. That amount could be the whole amount. It could be small amounts that grow as I make payments. Those amounts could include interest if interest is being compounded and capitalized. And when I decide how much of the expense to include, when I'm looking at that amount, I also have to consider, did I borrow the money at the beginning of the month? Did I borrow the money at the end of the month? Or did I borrow the money throughout the month? So that's the amount. The second thing I have to determine is interest. Interest. So here I'm looking at a couple of things. I'm looking at percentage. What is the interest percentage? And remember, if it's a general borrowing, we could have a weighted average that we work with. And then I'm also looking at compounding. How does interest compound? Is interest compounding monthly? Is it compounding quarterly? Is it compounding annually? How is interest compounding? Interest compounding means that we add the interest to the capital and we pay interest on interest. That's what compounding means, interest on interest. So how is interest compounding? Because that will affect your calculation. The amount, the interest percentage, and how interest compounds. And then the last bit is the period. You will work according to one of two things. Either the expenses paid period. So they may say to you, expenses are paid monthly. You have to work monthly to be able to work out the interest correctly. They may say to you, expenses are paid quarterly. Then you have to work quarterly to work it out correctly. Or you will work when interest compounds. So if they say to you that you only pay it quarterly, but interest is compounding every month, you have to work monthly because you have to keep adding the interest to the payment, to the capital. So you will work at the lower of these two, lesser of. In your scenario, at third year, what I've seen is that usually those two are the same, or the payments are the ones that you're guided by. So predominantly we're working with this one, with the payments. I've never seen, not at third year level, where the compounding is quicker than the payments. So either it's the same, or compounding is annual but the payments are quarterly, so we still would work quarterly. Okay, so let's practice some examples in your study guide. Example 1 in your study guide is a very complicated example. Example 1 in your study guide, and it is an example that I would suggest you work through. We're not going to have time in class today because we have to get through the assignment. But example 1 in your study guide is, sorry, where did I want to be? Sorry, I wanted to be here. Example 1 in your study guide is an example that has a specific loan and a general loan. It has both. What happens is it's an asset that's being bought, if I'm correct, and you've borrowed money for the asset, but then it turns out to not be enough because you blow your budget and you overspend. And so then at some stage your specific loan runs out, and then you have to start using general borrowings. So it's just a question of doing two calcs. One, up till when your specific loan runs out, then your specific loan stays at that fixed amount for the rest of the time, and then a second calc for the general borrowing. And it's a very good example to practice. I think it's like that. Otherwise, it might be the other way around. It might be where initially you hadn't finished negotiating your loan. So what you did is you had a general loan, and then once you'd negotiated a specific borrowing, then you got your specific borrowing. But it's one of the two. So example 1 is a very complicated example. It's not one that I would suggest that you start with. So I'd suggest you start with these multiple choice questions. The multiple choice questions take you through the different scenarios. So the first one, on the 1st of December 2009, the directors decided to build a factory on a vacant piece of land. Sorry, it is in your study guide. It's on page... Okay, this is on page 60, but I think I took it from the 2015 study guide. So yours, I think, is going to be page 61 or 62, thereabouts. On the 1st of December 2009, they built a factory building on a vacant piece of land. They currently lease a factory. The lease will be terminated when the new building is brought into use. On the 2nd of January, they obtained approval from the council. Physical construction started the 1st of Feb. Expenses were incurred from the 2nd of January. The building was completed and ready for use. So if we look at dates, because remember the dates are important. Expenses were incurred from the 2nd of January. They say to you that in December they made a decision, but on the 2nd of January they obtained approval from the council. So that means that we had already submitted plans by that date. So for me, activities would have started by that date already, even though physical construction only started on the 1st of Feb. You can see that there were expenses incurred by the 2nd of January. Those expenses were to do with the architect fees and the submission of plans to council. So activities had started, just not physical construction, but activities had started. Activities started 2nd Jan, expenses started 2nd Jan. So we now need to look at when interest was incurred. And they say to you that the expenses were incurred on specific dates, you can see. And you can see that if we look at the dates, they are quarterly. So we're dealing over here with quarters. We're looking at January, April, July, quarters. And we also see that it's ready for use on the 1st of November. And what else do we see? We see that it was at the beginning of the quarter. So that means that the money that I borrowed, the 2nd of January, I pay interest on for January, February, and March. Then when April comes, the money grows. So now I have to pay interest April, May, June on the bigger money. But I will show you, I will work through an example with you. Then it says the above mentioned expenses were financed by a bank overdraft facility of 1.2 million rand. We're looking at, which was also used for other expenses. So it's a general borrowing that we're looking at over here. they say to you that the overdraft is 15% per annum, and they compound on a 3-monthly basis, so they're also compounding quarterly. It says in 2010, 31 December 2010, it was replaced with interest loans from directors. But look, that date of 2010 doesn't matter, because that's after the asset is now ready for use. So by then we won't be capitalizing interest anymore. The building was taken into use the 1st of December. It doesn't matter when the building was taken into use, except for tax, which we'll do a little bit later. What matters is that the building was ready for use on the 1st of November. So that's the date that we're going to be concerned with. All right, so if I look, it says calculate the amount of interest. So I'm just going to do a timeline for myself and for you. Our year end, if I just look again, is 30, I'm going to assume our year end is 31 December, although they don't say. 31 December is end of year, beginning of year, 1 Jan. We looked at our dates and we said we're going to start capitalizing from the 2nd of Jan. All the criteria is met: expenses, activities, interest. Then on the 1st of November, the asset is ready for use. So I'm going to stop capitalizing at that stage. Yeah. So what it means, if I look at months, is that I'm looking at a period of 10 months here, and I'm looking at a period of 2 months there. This 2 months, if you recall, is going to go to P&L. Right? Then I look at my expenses. The way that my expenses worked is there was a borrowing, I think it was 200, 1, 5, and 4. 100,000 Rand there. Then the 1st of April, 500,000 Rand. Then the 1st of July, 400,000 Rand. And interest is capitalizing quarterly. So if I look at my months, Jan to April is 3 months. April to 1 July is 3 months. July to November is 4 months. July, August, September, October, 4 months. But what I'm going to have to do is I'm going to have to split this into 2 pieces. A 3-month piece, because that's how interest capitalizes, and then a further month. And then over here I will have the 2 months for the P&L, and that's how I will do my interest calculation. So let me take you through it so that you can see how it would work, the interest calc. So I start off, and remember, what was my interest rate? 15%. 15%, yeah, quarterly. So I start off my calc with 100,000 Rand. I have to pay interest at 15%, and I have to pay interest for 1 quarter, for 3 months. Let's work with months. For 3 months. I do that calculation of interest. Just give me a sec. Let me get a calculator. Although there is a function, there is a calculator there in the tools. $100 times 15% times 3 months is 3.75. That's the first quarter's interest. Now the next quarter's interest will be 100 plus 500, because now I'm going to incur another 500,000, this one, plus the 3.75 because interest capitalizes. Again, times 15% times 3 months. 100 plus gives me 22,640 for 3 months. And now I just want to make sure that I have got the numbers right. And now I capitalize again. Now I'm going to pay on all the capital. So I'm just going to start with the million. And I have interest of 3.75 and I have interest of 22,640. Again at 15% for 3 months. 1 million plus 3.75 plus 22.640 times 15% times 3 months. 38,490. Now I have 1 more month to do. So now I've done those 3 months, I've done those 3 months, I've done those 3 months. I must do 1 more month. My 1 more month is going to be the million, the 375, the 22, the 38,490 at 15%. But now, I was going to just say that, no, it's only for 1 month. So a million, 3.75, 22.64, 38.49. Times 15% for 1 month. 13,311. And that's the interest that I will be able to capitalize. 75 plus 22.64 plus 38.49 plus 13.311. 78,191. Then the amount that will go into my P&L. Remember I had a thing up there that said there's an amount that must go in my P&L. 2 months of interest must go in my P&L. There's no more compounding. So 1 month of interest, 1 month of interest lands up here. The other 2 months of interest for that quarter, 26,622, will land up in my P&L. Yeah? So that's the calculation for capitalizing interest. You'll see that when I look at my rules for interest calculations, I've got to look at the amount, I've got to look at the interest rate and how it compounds and the period. Initially for the first quarter, it was 100,000 Rand at 15%, which compounds quarterly for the first quarter, 3.75. For the second quarter, I had now borrowed 600,000 Rand. Interest capitalized quarterly, so I add my interest on, and it's at 15% for 3 months, 22,640. For the next quarter, it's now R1 million plus the previous 2 quarters of interest for a quarter. And then for the next 1 month, because I must stop in November, it's all of the capital plus the interest capitalized for the 3 quarters for 1 month. And that gives me the total interest. If you look at the question, asked, calculate the amount of interest that XYZ should capitalize, and we worked out 78,191. So it must be that 78,192, 78,192. This number over here is the interest that must be capitalized. Okay, let's just check the solutions. Question 1. I didn't put the solutions on here. Let me just check in your study guide if you follow through the solution. I don't want to assume that it is correct in case I have made a mistake. So in your study guide, about on page solution 1 is number 2, 78192. Okay, so that's your calculation. That's more or less the calculation you will always be doing. You need to work out the amount, you need to work out the interest rate, and you need to work with the compounding period, which is almost always equal to the payment period. But you see that for that last 4 months, we don't work with 4 months because we first have to capitalize interest. All right, let's look at the next example. The next example says the same information except bank compounds interest annually. Now, if I go back here and bank compounds interest annually, then I'm not going to be compounding interest all the time, isn't it? So if bank only compounds interest annually, there's a quicker way almost to do the calc. Or what I can do when I do my calc is I can just ignore this compounding. So I won't compound that, I won't compound this, I won't compound this, because interest is being compounded annually. But another way to do it, if interest is only being compounded annually, is to just do a much simpler calculation, which just says 100,000 Rand, I had interest at 15% for the full 10 months. 500,000 Rand, I had interest of 15%, but now this one was only for 7 months. And 400,000 Rand was interest at 15%, but now only for 4 months. Yeah? So it just looks at the fact that I had borrowed it here and I owed it all the way to there. This one I borrowed here and I owed to there. And this one I borrowed here and I owed to there. Yeah? So if you do that calculation, I'm going to do them quickly. Or you could have followed the old calc. But remember, we're just doing interest calcs. So as long as you understand the principles and you can do your interest calcs, I get 8.333 over there. Let me just make this a bit bigger. So over here I get 8.333. Then I've got 500, 15% times 7 months. And I get 43,750. And then I get 400 at 15% times 4 months. And I get 20. And if I add those bits of interest, $8,333 plus 43,750 plus 20. I get 72,083. If we go back to the calc, let's see, 72. It isn't one of the numbers on there. Did I make a mistake? Maybe I added up wrong. Let me just double check my numbers. $100 at 15% for 10 months. Yeah. I'm sure you're sitting there going, yeah, calculation error. 12.5 plus 14.75 plus 20. 76,250. That's now the correct answer. Sorry, I don't know what happened there. 76,250. If we go back here, see that the answer is 76,250. All right, so example 1 and 2 are both examples of general loans. In the one case, we're compounding quarterly. In the other case, it only compounds annually. That means that for my period, it didn't compound at all, isn't it? Let me just go forward. For my period here, it didn't compound at all in the purple. Okay, then the next question, same information, except now we used a mortgage bond. The funds were released by the bank as and when the expenses were incurred. The interest rate was also 15%. Now, this calculation, although the rule for this calculation is interest paid less interest received, because now we've got a specific loan, a mortgage bond. So when we have a mortgage bond, it's interest paid less interest received. In this case, with the mortgage bond, there is no interest received. Yeah? So this one is null. So there's only interest paid. And when we've got a mortgage bond, it's a facility. We get the money as and when we need it. The funds were released by the bank as and when the expenses were incurred. So when we look at this calculation, it's the exact same calculation that we had worked out when we did this one. In this one, we were saying expenses times interest rate. The calculation is identical now, except that we are using a different different rule. The rule now is borrowing times interest rate. But because borrowing and expenses is the same number, then we land up with the same answers. So for a specific bond where the expenses were incurred, the funds were released, it was a facility, the calculation of interest is identical. So it's 78,192 there and 76,250 here when it compounds annually. So what you can see is that when I have a general borrowing or when I have a specific borrowing, but if it's a facility, the calculation is identical for both. But the rule is different. My general borrowing is expenses times interest rate. For my specific loan, my facility, the rule is amount borrowed times interest rate. But if amount borrowed is exactly the same as expenses, as it usually is, as it was in this question, then the calculation is identical. So if I just go back to my picture that I had drawn over here, this calculation for general loans is exactly the same as this calculation for facility for specific loans. And the reason for that is because the expenses incurred on this side over here are identical to the interest. The expenses incurred times the interest rate is identical to the interest paid on that side. All right, we're going to look at one more example, which is a facility, and then I'm going to talk to you about tax. So question 5. Use the same information as question 1, except the building expenses were financed by a mortgage bond, which cannot be used for any other purposes. The mortgage bond was approved and the funds were received in the bank the 1st of January 2010. Interest of 5,000 Rand was received. So there's interest received. We're going to have to adjust for that. Calculate the amount of interest they should capitalize. Now, you could use your financial calculators to do this. But I caution you, because some financial calculators don't like to have pieces of a period. Because remember, what you're going to have to do is you're going to have to say present value is R1,000,000, because that's the money that I received from the bank up front. Interest is 15% divided by 4, because I want to work in quarters, yeah, because it's compounded quarterly. Interest okay, I'm assuming it's compounded quarterly. Doesn't actually say. But I think the next one says the same information except it's compounded annually. So this one is compounded quarterly. So we work in quarters. And then because we're working in quarters, we have to say how many quarters is 10 months. So we're going to say 10 divide by 3, because a quarter is 3 months. So we land up with I think it's 3.333. I just want to double check. But yeah, I'm sure that is what it is. 3.333 quarters. Now, some calculators, as I've said, don't like that quarters. And so therefore it causes a problem when doing the calculation. So you could also obviously do the calculation the long way, the way that we practiced before. If I do the calculation the long way, then I say I had R1,000,000 at 15% for 3 months. Then I had R1,000,000 plus interest at 15% for 3 months. Then I had R1,000,000 plus interest, the 2 bits of interest, times 15% times 3 months. Then I have R1,000,000 plus interest times 15% times 1 month. Yeah? It's the same calculation we did earlier, except now our number here is always R1,000,000. Yeah? So if you do that calculation, you land up with an answer which is 37.5, the first 3 months of interest, then 38.906 for the next 3 months of interest, then 40.365 for the next 3 months of interest, and then 13.96 for the last month. And when you add all of those together, you get an answer that's not there. How weird is that? Solution 5. Okay, you get 137.31. 137.31. Then I take the 5 off, and I land up with 125.731. I always forget then to go and take that interest off. All right, so if we total up over here, I get 137.31, and then I've got to take off 5, and I land up with 125.731. You can go and check those calculations. I'm not going to do detailed calcs again for you. I said, this time value of money calc you can do on your calculator because the amount doesn't keep changing. The one before we couldn't do on our calculators because the amount kept changing. So this one you can do on your financial calculator. Then you ask for future value, and the future value will be the R1,000,000 plus the interest, and then you can just take the interest off. In this case, your future value should have come out at 1,130,731. That's what it should come out at. If it doesn't come out at that, your reason is because of your pieces of your quarter, and then you have to work in 2 bits. If you really do want to use your financial calculator, you first have to work with 3 quarters. Do the calculation for 3 quarters for the 9 months, and then do the calculation for the other piece of the quarter by dividing your interest by 12 and saying then my period is one, which is 1 month, and then my interest is divided by 12 for interest for 1 month, and then you can do your calc in 2 pieces. Some calculators, I think it's the HPs, don't like pieces of n. Whenever you've got pieces of n, 3.333, it doesn't like it. It won't give you the right answer. Okay. The next calculation or the next question is the same again, except that now the bank compounds interest annually. So when the bank compounds interest annually, I don't have a problem at all. It's a very, very simple calculation. It's R1,000,000 at 15% for 10 months. And it doesn't compound at all because in those 10 months there was no compounding. So 1,000 times 0.15 times 10 over 12 gives me 125,416. sorry, no, it gives me 125, and then I take the 5, and I land up with the 120 being interest that I can capitalize. Okay, so we've looked at examples. I'm just going to go back to my principles page again. If you want to go back and redo examples for yourself, we've looked at examples where there was a general borrowing. That was example 1 and 2. Then we looked at an example that was a facility. That was example 3 and 4. And then we looked at an example that was an upfront loan. That was 5 and 6. 5 and 6. Okay, I now need to talk to you about tax. I think that's what this one is all about. Yeah. So I'm going to just add a page in here to talk to you about tax. Okay. There's always tax in any third year module that we do, and so we need to look at the tax implications of borrowing costs. Now, SARS allows interest as a tax deduction, and there are some like funny rules in terms of interest and tax deductions, but for accounting purposes, we're going to look just at the main principle. SARS allows interest as a tax deduction in production of income. In production of income. What this means is that SARS will never add interest to an asset. So wear and tear is on the cost of the asset, excluding interest. Wear and tear is on the cost of the asset, excluding interest. So SARS will never allow a tax deduction on an asset. What becomes an issue for SARS, so in other words, we will have deferred tax, because what happens is we put the interest into the asset and depreciate. SARS doesn't. Okay. But what becomes an issue for tax is this story here about production of income. Because until the asset is brought into use, it isn't producing income. So therefore, only when asset is brought into use. And so only when the asset is brought into use do we have this deduction. Until then, it's called pre-production interest. Until then, it is called pre-production interest. And pre-production interest is something that lands up in your deferred tax calc. It creates a deferred tax asset, and it is then only allowed for tax later. So if we look at our timeline that we had earlier, we had this asset that was ready for use on the 1st of November. And then in the question they said to you, it was brought into use on the 1st of December. Brought into use. Now, from a tax perspective, then that's fine because it's before the year end. But if they said to you that it had only been brought into use in January, then all of this interest that I incurred on this loan would not be deductible until January. All of it, the piece that was capitalized and the piece that went into P&L. Okay, so let's look at an example. We're looking at example 7 down here. Example 7. So example 7 says, BC manufactures motor vehicles. During the year, they built a machine to manufacture the bodies of the vehicles. It was built for 6 million rand, and the loan bore interest of 650 that was paid to the bank at the end of the year. Interest of 500 was capitalized, and it was ready for use on the 1st of November and brought into use the 1st of December. Okay, this one here doesn't actually have a problem. I think that maybe one of the next, okay, this one here is the one that we're going to look at. The machine was taken into use the 31st of January. So let me draw my timeline. Oh, no, black timeline. All right, so that's my year end. What day did they say the machine was brought into use? 31 Jan. So 31 December, end of year. 31 Jan, brought into use. Let's just look at the amounts or the dates again. Completed and ready for use, 1 November. 1 November, ready for use. And what they said is that interest, total interest, was 650, and capitalized interest was 500. Okay, let me just double check that. Total interest 650, capitalized interest 500. The machine cost 6 million rand. Ready for use plus 6 million. So then the total value of my asset, 6.5 million. That asset is going to be depreciated for November, December, 3 months. Okay, let's have a look what else. It says depreciation is allowed over 8 years and SARS is over 5 years. So this here will be divided by 8. And SARS allows this amount over 5, I think it was, for SARS. Let's just double check. SARS will allow it, straight line over 5 years. Okay. If we look at the deferred tax calc, first of all, the machine is only brought into use the 31st of Jan. So what that means, the implication of this is that there is no wear and tear and no interest deduction in 2010. Yeah, which was our 31 December, or let's just say in current year. In current year. So, when I look at my deferred tax calc, then, if I do a quick deferred tax calc for us over here, then my deferred tax will be as follows. PPE, carrying amount. Sorry, let me just make some space. Deferred tax, carrying amount, tax base, temporary difference, deferred tax. And I'm going to start with my PPE. My PPE carrying amount is 6.5 million. I'm going to depreciate for 3 months. 6.5 divided by 8 times 3 over 12. 203. 125. 203, 125. So let's have a look. 6.5 divided by 8 times. You see, I've got those months wrong. I'm sure I said 2 months and then I wrote down 3. November, December is 2 months. 135,417. 6.5 divided by 8 times 2 months. 135,417. So the carrying amount of my asset, 6364. I'm just going to work in thousands. 6365. Tax base of my asset, 6 million. No wear and tear allowed yet. Temporary difference, 365. Deferred tax liability, 102. So I've put an amount of interest into my tax. I've put interest into my asset. That interest is only going to hit my P&L as I depreciate my asset. And so therefore SARS will allow the deduction up front, and so I have a deferred tax liability. But then there's pre-production interest, because SARS won't allow that 650 as interest. So it is an asset. It's a future deduction that SARS will allow. SARS will allow it as soon as the asset is brought into use next year. And so I'll end up with a temporary difference of 650, which is the other way. It's an allowable temporary difference. A deductible temporary difference is the word. And so I'll end up with a deferred tax asset of 182, which means I'll end up with a deferred tax asset of 80. So if we go and look at question 8, it says calculate the current and deferred tax amounts. This will be I imagine that this is going to be the answer, because I see a 79,917 because I had rounded. But let's do a quick current tax calc. So current tax, let me see what they say. They say the company had a profit of 10 million before the information was taken into account. So it's going to just be the 10 million times 28%, because I'm not going to put the depreciation in because I would have to take it back out. I'm not going to put interest in because I would have to take it back out. And so that's just a straight 2.8 million rand. And so when I look at the question, which one is the right answer? The right answer is number 1. Okay, so that's the story with tax. We always need to be very, very careful with the dates. When the asset is only brought into use in the next year, we'll end up with this thing called pre-production interest. Pre-production interest lands up giving you a deferred tax. Sorry about that. Pre-production interest lands up giving you a deferred tax asset. Pre-production interest lands up giving you a deferred tax asset. Where's my deferred tax asset? Oh, down here. And then you always need to be careful with deferred tax assets to check in the question to see if there will be future profits to utilize those assets. Okay. All right, so that's borrowing costs. It's not difficult, although students struggle with it because they struggle with the interest calculations. In your assignment, part C of yours, disclosure quickly. So presentation and disclosure. In your PPE note, we will see an amount for borrowing costs capitalized in the year. And there it lands up in your PPE. Then, in your deferred tax, we land up in deferred tax with borrowing costs giving you your temporary difference in your PPE. In this case, it was just PPE. Remember, in this module, we just say PPE and we put the amount in. We don't talk about what kind of temporary difference it is, because remember, in PPE, we could land up with a number of temporary differences. It could be a temporary difference because of a reval. It could be a temporary difference because of a government grant. It could be a temporary difference because of borrowing costs. It could be a temporary difference because wear and tear is not equal to depreciation. And so if you're going to say analysis of temporary differences, then you're going to land up having to split that temporary difference in your PPE into all the pieces. So we don't do that. We just say PPE and we put the number down. Then this is the note, the additional note, the new one that you haven't seen before. Debt, finance income or cost. It can also be included in your no, it wouldn't be. It could be included in your profit before tax note because it is part of profit before tax note, or include in PBT note. And often in the solutions, that's where you'll see it, in the PBT note, or you can have a separate note for net finance income. And what you see happens here is that we put in the total interest expense, then we put in how much was capitalized to land up with what goes into your P&L. Okay, so total expense 1241, capitalized 620, P&L 620. And then we do the same with the interest income, total interest income, interest capitalized, and what lands up in P&L. Yeah. They also talk about a bit of descriptive disclosure in terms of the rate that we capitalized interest into our qualifying assets at. That's going to be an effective I for disclosure purposes. Okay, that's why you see it's a funny number, because it's effective I. When we look at the amount of interest capitalized, 620 less 25 needs to balance back to this 595, otherwise the numbers start to look screwy-looey if the numbers don't. Okay, then, assignment. The following information relates to questions 6 to 10 in the assignment. You need to draw a picture, and you need to do the assignment questions. I'm going to leave you to do those, and then I'll come back once you've had a chance to have a look. Okay, so you've had a chance to have a look at questions 6 to 10. Let's have a look. Let me just put it in as a dual screen. View dual page. Display. Okay. All right, so there it is. Here's the information on the left. The directors approved the constructing of the new plant. And in terms of all the details, we realized that it all starts on the 1st of June. Costs were incurred the 1st of June, and taken out the 1st of June. So our criteria is all met on the 1st of June. Then we have capitalizing. The interest capitalizes every 6 months. So we have interest capitalizing at December, and then 6 months later on the 1st of Feb. And 6 months after that. But on the 1st of Feb, the asset is ready for use, and so it comes into use on the 1st of Feb, and 28 Feb is our year end. So if we look at months, we have an 8-month period that we're going to capitalize interest, a 1-month period that we're not going to capitalize interest. That interest is going to go into our P&L. And we're going to compound interest every 6 months. Yeah, every 6 months. So we start off with a loan of 15 million. We got all the money up front. So upfront loan. We got all the money up front. So 15 million rand we got up front. Interest for the first 6 months at 15%, I think is what it was. No, at 10% is 750,000 rand. It would have been 1.5 million if it was for the full year, so it's half a year. And then I take off my installment. There are annual or half-yearly installments of 1692381. And I could also have used an amort table. But because I'm doing just one in a period, I'm just going to work simply. I start with 15 million. Interest is 750 for those 6 months. I take off my installment. My balance at 1 December is 1405. 7619. If you did an amort, that would be your balance at the end of period 1. Then my period 2 interest, I need to split. I need 2 months to go into being capitalized, 1 month to go into P&L. So period 2 interest, if you did the calculation on your amort table, you would have got a number for 6 months. 2 months would have come to 234, 1 month to 117. But if you do it manually, 14057619 at 15% for 2 months gives you that number, and for 1 month gives you that number. So that's the interest for the 2 months, and that's the interest for the 1 month. So then we're looking at the interest that we're allowed to capitalize. The interest that we're going to capitalize is the 8 months, 984,294. Then they said to you in the question that there was interest received. Interest received is 15,250. So therefore, the interest that we're going to capitalize is 969,044. So our total asset will be 15,969,044. We're going to depreciate it for 1 month. We're going to depreciate it for 1 month. 133,075 is your depreciation, and there's your carrying amount at the end. They say to you that the asset is ready for use on the 1st of Feb, but it's only brought into use on the 1st of May over here. So we know we're going to have a deferred tax. So hopefully you were able to do those calculations. It was an upfront loan. Those are the easiest ones to do, the upfront loans. And it was compounding every 6 months, but that was your period of your installments as well, every 6 months. And it was a normal amort table that you could have done on your financial calculator, or you could have done manually. Okay, so to answer the questions then, the first question over here was the borrowing cost to be capitalized to the qualifying asset, and the answer for that one is number 3, 960044. 960044. There's my 96944. It's the cost of 984,294 less the 15,250 interest capitalized. Then in the next question, question 7, there we go, question 7, it asks you what is the tax base of the plant is not being depreciated or amortized, so the tax base of my plant is 15 million. 15 million. Then number 8, capitalizing of borrowing costs should cease and depreciation should commence on the following dates. It's the same date. So that one, it's a no-brainer because the only one that has the same date, oh no, May also has the same date. This one here, it could only have been 2 or 4. It has to be the same date. That's not the same. That's not the same. That's not the same. So it could only have been 2 or 5. Sorry, not 2 or 4, 2 or 5. And in this case, the answer is 2. That's the date the asset is ready for use, and it's possible that we should stop capitalizing. Question 9. If it is assumed that the total interest capitalized is 2 million, the tax allowance on the asset for the year ended February is, the tax allowance is nil. The tax allowance is nil. The asset is not brought into use. Until the asset is brought into use, there are no allowances. In that case, the tax allowance is nil, no wear and tear, and no interest deduction. Given the above information, assume the interest payable on the loan amounted to 2.5 million rand. Borrowing costs to be capitalized of 2 million rand. The amount to be expensed, is the balancing figure. So that was pretty easy. So they said, assume that the total interest for the year was 2.5, that the amount that will capitalize into the asset is 2 million. So therefore, the amount that will be expensed is 500,000 rand. So there are the answers for the 5 questions in the assignment that deal with borrowing costs. Okay, remember, borrowing costs is fairly straightforward. It's not a difficult section of work. The principles are easy. The principles are, if it's a specific loan, any interest paid less interest received are capitalized. If it's a general loan, expenses incurred times the interest rate is what I capitalize. I must make sure that I draw a timeline so that I keep track of months and years. Where's year end? How many months go where? And then I must make sure that I do my interest calculations properly and on the amounts, the interest percentages, and the periods. All right. So that's borrowing costs done. We will next week start look at employee benefits.